So Rick Rieder's here. He's BlackRock Managing Director and Global Chief Investment Officer of Fixed Income. He could talk about equities, too, but, Rick, we really want to focus on fixed income in the bond market right now. So is the market generally.
It's a pretty incredible thing. I mean, so it's telling you more than I think a barometer of the economy. People say, by the way, I think the economy is slowing. It's slowing moderately. The service sector is actually pretty good. The consumer is actually pretty good. So it's slowing moderately. I think it's not telling as pernicious a story about the economy as people suggest. It's telling
not flashing a recession signal.
No, and I think when people say, my God, the flatness of the curve, that's a recession, it's actually a good indicator over time. Well, a couple of things happening that are extraordinary. One is the ECB is about to go and buy everything left in the rates market, flattening the yield curve there, making negative, with German bonds at negative 60 or so basis points. It's extraordinary. So that's pulling. There's an immense gravitational pull as investors looking for where in the world do I have positive yield. The other one, there is the most extraordinary demand from pension because of the aging demographic we talk on the show all the time. The pension insurance demand, and there's just not that much debt issuance coming on the market. People focus on the treasury issuance. But companies are delevering. We're in an asset-light, capital-light world. We used to have secured assets from mortgages, securitized products, factories were being built. You're not issuing that much debt today. We're in this unbelievable oasis. The demand for product, the demand for income is immense. And there's just not that much debt other than treasuries. So it's insurance companies, pension funds, you have to buy these things, which is why they continue to push rates down. I mean, is there going to be a time when they look at it and say, we're not going to buy negative interest rates? We're not going to give our money away to the... So you get a dynamic, though, where you've got a liability stream, whether it's a pension insurance company. And I think what you saw this week is this scramble for, gosh, I may see the last 2% instrument to hedge my liabilities, and that's what was creating some of this pressure.
We can make this more complicated than it is.
Yeah.
But maybe it's a simple supply-demand issue. So in that sense where there's huge demand, not only for the demographic reason, but there's the flight to safety aspect of it.
Yeah.
And the answer, and I'm going to duck after I say this, is maybe we ought to be issuing a lot more debt.
Or 30 years or 50 years.
30s, 50s, 100s.
If
people want it,
you're not going to have to duck.
Let's give it to them.
And we have all the sell-side guys coming on scared bowelless, or however you want to say it, and they're scared. And then you got Mark Mobius, and I want the guy to come on, who said this is going to be unbelievably positive for stock markets because of dividends.
It's true. It is definitely
think
true.
About 3%. There's some normal companies that are not, where you're not saying, wow, is that dividend safe? There's a lot of great companies yielding 2.5% to 3.5%.
By the way, the free cash flow yield of the S&P 500 is 4.3%. You map that against what's the duration of equities, a long-durated asset.
If you keep it simple, stupid, and I'm not talking to anyone on the set at this moment currently. If you say that, then why wouldn't you buy yield stocks? Why wouldn't you buy, I don't know, take your pick?
So you would. It's a question of, do you buy yield stocks, do you buy stocks that will participate in an expanded multiple? If you think growth, and some of the things we'll talk about, if you think growth is going to be okay, I don't believe in the business cycle argument that people have said before. It happened in a manufacturing economy. It happened when you had a goods-oriented economy getting into chemicals and energy.
You can buy growth stocks that yield as much as the 10-year that are going to raise their dividends as they go forward. You don't even need to buy dividend stocks.
That's what I think is right.
That assumes there's a market mispricing in the risk adjustment. But Rick,
can I just say one thing that I think is really important? People talk about, my God, there's so much debt in the world. If you think what the markets pivot off of is rate of change. Debt was built 5 years ago, 10 years ago. The last couple of years, you take U.S., Europe, Japan, certainly China's issuing more debt. But the actual rate of change, other than treasuries, is actually not that significant. So there's no bonds for people to invest in. That's what's pressuring the risk.
We can come back and talk about this at 8:30, maybe after housing starts. But very quickly, before we have to go, your outlook for the Fed here. Are you a 50 or a 25er? For September, are you a 75er for the year? Who are you, Rick Rieder?
So I've learned in my career, what you think they should do and what they do can be different. I think they should go 50. In September, I think they should go 50 because the economy is less interest rate sensitive than it used to be. The only way you get transmission in the economy, particularly as you approach the zero bound, you should go 50, and then, by the way, step back and say, you know what, we're going to evaluate the data from here. But the incrementalism in an economy that's less interest rate sensitive doesn't, particularly when you're easing, and particularly when you're close to the zero bound. Do I think they'll go 50? I think the market odds are about right. Listen, when I say it's 50-50, maybe I shouldn't say it this way, 50-50, they go 50. But I think that is, I think that's probably closer to right. It's the right thing to do, and then you could step back, particularly with the ECB. and you have to be really careful about the dollar. If you're the Fed, think about what happened last year. You shift rates higher, you get this FX reserve recirculation through the system. The Fed has to operate. Totally. Yeah. Fed has to operate in a global economy. There have been 20 interest rate cuts by central banks over the last few weeks.
You should have been watching earlier, because that's what I said. Economists someday will get something before it happens, and we'll be able to forecast it before it happens, because none of them realize that rates this low could actually be too high. And Correct. The reason is because of FX and foreign differentials.
100%. The equilibrium rate of interest.
Why didn't anyone tell us that 2.5 could be restrictive?
So I think we were on the show when the Fed was hiking.
Maybe you did. That last guy claimed he did too, but
I think we said the Fed pause was a right thing to do.